Everybody, I'm Alan Lehman, the Chief Executive of the MCA. It's a great pleasure to welcome everybody to this MCA webinar this afternoon on a glorious London afternoon. We're joined today by Equiteq, who are global leaders in providing strategic advisory and also M&A services to management consultancy firms. And they're going to be discussing this really important topic: are you scaling smart or scaling towards failure? A question I know is on the mind of many senior managers and owners of consulting firms. Delighted that we have with us today two presenters, Bruce Ramsay, Investment Director, and Adam Blatchford, Senior Analyst, who are both based in the London office of Equiteq. They'll be presenting, and then I'll be putting some of your questions to them later on in this webinar. Now, you have the opportunity to ask some questions by using the control panel on the right-hand side of the screen. The questions box appears towards the bottom, so please do make use of that, and let me assure you that any questions that we don't have time to deal with this afternoon, we'll get answers to you later. So with those words of introduction, thanks very much to both Bruce and Adam, and over to you.
Thank you, Alan. Well, good afternoon, everyone, or good morning, depending on where you are in the world. Thanks for joining us. My name's Adam Blatchford. I've been with Equiteq for about 5 years here in our London office. I work with our clients to prepare their firms for sale, mainly. I work with shareholder teams to articulate and align their goals and then plan their path to exit. So I've also worked with a number of larger firms looking at their acquisition strategies and looking at how to drive their growth. So Bruce.
Thanks, Adam. Bruce Ramsay. I've been at Equiteq 7 years, leading many of the deals we do here out of the UK and across Europe. The background, my background is relevant for this conversation also, where Equiteq, how Equiteq came to be. I joined a small consulting business called World Class International, a big name for a small group of people, back in the early 90s, where we were doing operational performance improvement, keen amateurs going about doing our task. And during that period, we decided we're doing 2 or 3 million. We decided to get serious about growing the company and growing the value of the business. And we learned quite a lot during that process as to what works and what doesn't work. But nevertheless, we managed to get to fruition and do an exit with private equity for a 50 million odd value in 2003. So after that deal, and during that process, I migrated from being a business development director and then set up an IT services business doing Microsoft Dynamics within that unit. After we'd done the exit, the founder of that business, Paul Collins, then left to set up what is now Equiteq, to advise other people through the process of growing their consulting businesses. And then he supported again others as they went through exit, and was reminded during that process of the positive advice he got for people helping to sell businesses, the consulting businesses, rather than asset-based, more traditional businesses. And so it was that Equiteq, in about 2007-06, started getting involved in doing transactions for consulting businesses. So now our focus is entirely on M&A, growth services and M&A in consulting businesses. And in consulting, we do include classical management consulting, process change type work. There's also engineers, there's media people, there's people involved in HR type services as well. So, and particularly IT, a lot of range of IT implementers, all of whom we consider to be professional advisory consulting type businesses. And from those early days, we've now grown. We're about 50 people across the world. We are head office here in London. The New York office is growing very quickly. A lot to be done over there. We also have an office in Singapore that's our entree into the Far Eastern market. And Sydney is a new start in the Asia Pacific area. So it's only consulting businesses, primarily sell side and growth, and delivering great results for our clients in terms of valuations and multiples. So that's Equiteq. So everything we're talking about is from pragmatic experience of helping people go down this path of transition.
So today we'll be focusing on smart scaling, and what we mean by that is ensuring that business growth translates into equity value growth by avoiding mistakes and missteps. So of course you make decisions every day in running your businesses on the direction of the business, but while you're working hard scaling your firm, do you know if you're also scaling your equity value, or could it be eroding behind your back without you realising? Now, smart scaling is all about having the confidence that your decisions are safeguarding that value into the future and increasing the likelihood of a successful sale. So the best way to know if you're doing that is to understand what future buyers will be looking for. And so at a high level, buyers are looking for firms with critical mass, consistent performance, focused propositions, focused sectors, focused geographies, and leverageable intellectual property. And by considering how a buyer will view your firm when you're making decisions now that affect your future, you can ensure you're building that value alongside scaling your firm. And that's what we mean by smart scaling. So during the webinar today, we'll be covering the following topics. We'll start by quickly talking about why growth is key to running a successful consultancy and how understanding the way buyers look at a firm can help you ensure you grow and maintain your equity value while scaling. Then we'll have a quick look at some of the areas that buyers look at when acquiring consulting firms and a few of the options available to you in scaling your firm. And these are some of the decisions you can make on your strategic direction, and we'll think about how buyers might view the outcomes of those choices. And then, as Alan's mentioned, we'll finish off with some time for questions. So if you've got any questions, send them through to him, and hopefully we'll be able to answer them at the end.
So start with a hypothesis that a successful consultancy is a growing consultancy. It's certainly a fairly strong belief of ours that stagnation or falling growth is not a successful business for a number of reasons. It prevents you from making investments you need to make in people, in IP, in market extension. You're throttling back rather than running forwards. And we don't really care whether you're aiming to grow the business for its profitability and release of cash and dividends, or whether you're looking to drive it in terms of the equity value. In both areas, you do need to be a growing business in order to be successful. So what are buyers looking for when they start examining your business as a potential acquisition? In summary, basically the four themes that we want to look into. The first is the consistency of your growth and your revenues and profit and the pipeline going forward. The next is the size of your business and where you fit in a range of people's interest parameters. The next is focus on what you're doing. And finally, the intellectual property that you have within the business. I'm going to look at each of those in a little bit more detail now. The first is to do with pipeline and growth. A lot of this involves understanding buyers' concern and risk about buying a people-based business and trying to maximize their certainty over the future performance of the business they might acquire. And the first step in that is really all to do with the revenue and profit, maintaining a consistent and upward movement in those. There are some exceptions. A lot of businesses had one bad year at some point during the last recession, depending on which part of the industrial segments they worked in. So one bad period you can get away with, but more than that, it begins to make a troubling and concerning story to potential acquirers. And the other side, the other way you can get around that is, while the total business might not be growing radically, if the sub-elements within the business, a particularly new service that now represents 80% of your business, has grown from 20 to 40 to 60%, that will be an upward trajectory even if the total business does not present such a positive story. On the other side is obviously profits that once an adjustment process has been gone through, present a solid and upward picture as well. But obviously revenue and profit is very much looking backwards. The other side is obviously looking forwards, and the greater the level of booked work that's normal within your business, the greater the certainty that buyers are going to have. So strong forward pipeline, both firm booked as part of programs of work that you're working on where the order hasn't actually come through yet, but you're doing the work, is important. And finally, obviously, a discounted pipeline of well considered opportunities will also be critical to that. So that's the first thing, the consistency of the pipeline. The next one is scale. Now, certainly, businesses of any size do sell. There are about 2,000 deals a year that take place for consulting businesses around the globe, and a very large proportion of them are at the lower end of the size scale. But of course, the fact that a transaction is taking place doesn't mean significant value is being shared between from buyer to seller as a result of that transaction. So our hypothesis we have put forward, certainly on our experiences, that small deals tend to be more of a team hire, innovation of contracts, etc., rather than sellers achieving a premium price. And it is often a reasonable route for people to go down if they believe their futures of their and their staff is greater in the new organizations, is an independent business, it's worth considering. At the top end, clearly there are some mega deals, I don't know, Dell, EMC, etc., but they're few and far between, and really not relevant to most of the people we deal with or the sort of people who are on this conference today. So what is the sweet spot? Well, hurdle one is what we call 5 and 1. And I'm not that worried which currency, whether you use a euro, a dollar, or a pound, they all seem to be going pretty much 1-to-1 at the moment. But if you've got 5 million on the top line and 1 million on the bottom line, then you will genuinely be big enough to acquire at a properly valued price rather than a team hire type price. But the sweet spot is in the 20 to 30 million. You are big enough to make a difference to somebody, but not so big as to make a significant integration that they may have trying to handle. So in terms of size and what buyers want, I would say 5 and 1, but if you're in the 20 to 30, then you really are extremely well placed to appeal to buyers. The next one is focus, and this is incredibly important. The first one and the most important one is service focus. It is making sure that you are doing something that is all falls within a limited range of service offerings, so that potential acquirers can say, you are one of these, and therefore I would like to acquire you. Having multiple services, particularly if there's not a firm link between them, then becomes a problem for a buyer, knowing what exactly you are. And obviously the bigger you get, you can always break a business down and say it's got multiple services, but there must be a coherent link between them all in terms of what you're doing. The next one is sector focus. It is not always possible, but it is ideal to have a sector focus for your service for two reasons. One is it's easier for you to sell your service to your customers because you are talking their language, and while there may be a logic as to why a new sector could acquire your services, you won't be talking the same language. But the second one is that most buyers are segmented by sector. And if you have a multiple sector focus, it makes it extremely difficult for them to find a way to fit you into their organization. So going multi-sector is something that can make a business far less attractive to a potential buyer. And the third one is geographical focus. A similar issue to sector focus in terms of who's going to buy you, and once you start having bases in different countries, you then limit the amount of buyers. But it can be very difficult for people to acquire you if you've got offices in areas in which they do not wish to compete. And we come across this quite often, where someone's grown a 10 million business and they've gone and done a little bit of growth. They may be European based, heavily in the UK, and they think South America is a great idea, and they manage to get another 3 million down there. That is highly unlikely that there's going to be a buyer who happens to want a UK-focused European business with service sector X who also has a presence in South America. It might happen, it's just extremely unlikely. So maintaining a geographical focus, unless there is a very good reason to go and do it, is, when the buyer's looking at your business, an extremely good idea. The next one is buyers looking for IP, intellectual property. Now, we're not talking about trademarks here. I'm not really worried about whether or not you've actually formalized it. It's normally not worth the effort, and by the time someone else has worked out what you're doing, you'll be one step ahead and further down the route. But we're talking things here that help you sell revenue-generating IP. They're your methodologies for delivering your service. They're about your thought leadership and why you will be the people to talk to and the deep domain experts in your field of expertise. And often, an extremely other example is benchmarking data, your ability to assess a client and know where they stand relative to other players based on a great deal of data within the focus sector or service that you're delivering. And one of the ways to look at this is to define what IP is to understand, if you have a consultant working for you who then goes off and works somewhere else, why are they no longer able to do as good a job as they were when they were working for you? And the reason is because they do not have access to A, B, C, and D, the way in which you do stuff. And that is, in the consulting world, what your IP is, the things that an expert in your field would not naturally have. The reason for this, reason buyers see this as extremely important, is that it mitigates the risk and uncertainty associated with the individual staff members, so that the knowledge and capability is within the business and not within the people who can walk from the organization. But also, it is what a lot of buyers are looking for in order to generate synergistic revenue and profit growth. If everything you do is dependent on the individuals you employ, it is quite difficult to rapidly scale that business. If your capabilities can be spread across a much larger organization, then clearly it is possible to argue and describe a large growth scenario. If you go to talk to some of the big four consulting businesses and other size organizations, they are, and you're a relatively small business, whether you're 5 million or 20, 30 million, the big guys, they can ring up any chief executive they want in the world, and they have tons of resources. They got mass graduate recruitment. They can get people into their organizations. What they're looking for is things to talk to clients about and ways of delivering the things they're talking about. And that is why, from a buyer's perspective, IP is so incredibly important. So, from the buyer's perspective then, what they're looking for is the growth and certainty. They're looking for size, a certain size. They want a focus, and they want intellectual property. Adam.
So, having heard about what buyers are looking for in consulting firms, you might be asking yourself, how does this affect me? What does this mean when I'm running my business, the decisions I've got to make, and importantly, how do I know if I'm making the right choice? And, of course, there's very seldom a hard right and wrong answer. These things exist on a bit of a continuum, and what's better for one firm may be different for another. But in the context of your individual firm at a specific time, there will be good and bad choices that can help and that can harm your equity value. So we're going to look at 4 options today. Should I enter a new market? What IP should I be developing? Should I make an acquisition to drive growth? And should I diversify my offering? And these are questions that we hear a lot from our clients, actually. They're often considering it for their businesses, and some of you may be considering these for yours. So we'll have a look at some of the considerations that you should take into account before making these decisions, especially around how potential buyers or the buyer market might view them, because there's parts of them which you may be unaware of, but they'll still have an effect on your equity value. And as I say, there's no intrinsically right or wrong options. They'll vary according to the timing, the situation, but what it does mean, in a certain situation, at a certain time, one of them could be the wrong choice for your firm. So to give you an idea of how to navigate along your journey and get the right ones, let's have a look at some of the principles and questions that you should consider before taking action. So, should I enter a new market? Well, first of all, there's 2 different types of market that we've sort of touched on with Bruce already. There's moving into a new geography or moving into a new industry sector. And although they're clearly quite different things, there's actually a number of considerations that apply to both of them. So of course the draw is potential new clients. A greenfield market, if you're the only firm that does what you do, you might have real potential to scale into a new market. But it can be difficult to do, and you need to build new relationships in places you haven't worked before. You've got to really ask, is it easier to build in this new market or to expand in our current one? And in general, we'd say it's easier to sell more of what you already do to people you already know, because you know how to sell it, you've got the pitches, you've got the case studies, you've got the relationships, and that trust is already there. So on average, we would probably say that is where you should focus your efforts, and only maybe 20% of the time focusing on new clients, because the effort required per sale is usually so much higher. And then new markets are a step even further away. So there's more difficulty, there's more effort required. So the key reason to look towards a new market is possibly that you feel you've exhausted your current one. And that might be true, but I'd caution you to really interrogate that before sort of acting on it to ensure that it's really the case. Because many clients have told me, yes, they have fully saturated their market. They have 100% of the available market share, and there's nothing else for them to do there. You can perhaps read from my tone that we weren't completely convinced when that was said to us, and when you look into it more carefully, often you find it's not actually the case. And it's often because they're just looking at their market in a sort of a very specific way, and they need to broaden the view of it and look at it in a different way. So a common oversight is that they actually are competing with internal capacity in firms rather than their competition being other firms like themselves. Their competition is actually within their own clients, and they haven't really thought of that, and therefore there might be a bit more work than they realise. So it just needs a different approach. But let's assume for now that actually your current market isn't sufficient from an opportunity perspective to hit your growth target. So entering a new market could be the right thing to do. Even if that's the case, don't underestimate the sort of effort and difficulty required. So a lot of firms expand too early, especially geographically, and find it's not sort of hit a point where it's not quite as successful as they were hoping. So geographic expansion, that is something we really do hear pretty often. A lot of people toy with often because they have a client that's moved into a certain geography and taken them with them, and there's a belief that they need to set up an office there, and that will be the platform for expansion. That's the only way they can service that client. But it's a risky thing to go for a number of reasons. First of all, there's a financial cost to it, obviously. There's the initial investment to set up an office infrastructure, potentially translation of materials, or new website and things like that. But that's sort of not the end of the cost. There's obviously the cost of time, which is pretty significant. We usually take a number of months, maybe a year, to hire new people, bring them up to speed, and really get them starting making profit. And until that point, you're going to be funding that office out of your cash from the central operations. And while it's running, you're also going to have additional costs to yourself in terms of operations from the different tax or financial regimes in the different geographies, that you're going to have to expand your ops team or retrain them to make sure they can deal with that complexity. And then in an industry sector point of view, really, it doesn't have quite the same cost burden as geography, but they exist still in broadly similar ways. So you don't need so much of the infrastructure, but you do still need to hire new specialists in that new sector, and they're probably going to be relatively senior hires, probably therefore expensive hires, and there's still going to be that time to get them up to speed, adapting your selling messages, delivery materials, etc. But actually, the most significant cost, possibly not in terms of hard dollars, but in terms of the knock-on effects, the negative effects it can have on your business, is the management time required. So it's not just a financial cost, but it's an opportunity cost, because that management team that usually has been focused on what you do is suddenly splitting their focus to another market. Potentially your top sellers are having to learn new markets, and while they're doing that, they're not exploiting the opportunities in your current market. And you don't want to spend a lot of time sort of setting all this up and waste some months of their time, and then find out by the end of the year you've got to hit to your top line and your bottom line because your current clients were sort of left on the sidelines while they've been sort of trying to learn new things. That's a distraction that you can't afford if you've got targets and things to go for. Now, I'm not saying, of course, that you should never enter a new market, of course not. But I'd recommend taking a step back and applying a degree of caution to that decision before you make it. We've helped a number of clients to work through the risks and the benefits of entering new industries and new geographies so they can make an informed decision around whether to go through with it. And some will choose to and some will choose not to. But then we can help them design a plan to really open up and build that new market in a structured way. So there are milestones for investment so that any new office or operations are getting what they need but are not unnecessarily draining resources from the core team. So now when buyers come to look at these, there's two ways that a buyer can look at different market operations. One that views it sort of more negatively and one more positively. And they apply equally actually to industry or geographic markets, but I'll use geographic sort of as an example because it's a little easier. So if the operations are small, if they're not really turning significant profits, they can be off-putting to an investor. So as you heard from Bruce earlier, if there's a few million in one area, a few million in another, the buyer needs to, first of all, get interest and buy-in from people in their organization that run those areas. If they've got offices in, say, Sao Paulo, Brazil, in South America, they need to go to the partner in their business there and get their interest and their buy-in. And then if there's offices in another area that they don't have an office, it becomes more difficult. And they'll start to question, well, is there the right fit for that buyer? But if we look at the opposite buyer perspective, and this is an important one, you can use an additional market as a demonstration that your proposition and operations can be scaled. So we can then argue that into a strong synergy case. Because what it says is, if you've rolled out and expanded into one market, you're then ready to roll out and expand into further ones, geographic or industry. And so we can show that as a good story to write into your information memorandum. So that's a document we use when we're trying to sell a firm, which we take to potential buyers to get their interest. And the story we can put there is quantifying all of the opportunity in the next 3, 4, 5 markets that the buyer could effectively, with their resources, roll out your proposition and expand you into. And that can be an argument for increased value for your firm because of the potential value that your business will deliver to them as a buyer. So what IP should I be developing? And as we mentioned earlier, buyers, they want high quality IP because it allows them to leverage, to deliver more with less. And that's valuable to you in running your organization for the same reason, because you can leverage cheaper, less experienced resources, and you can deliver work which is more valuable to the client because they're supported by all the knowledge and experience of your firm that you've distilled into your IP. So when you're deciding what you need to do around IP, you need to make sure that you're focusing on the right IP for your business. So there's a risk you could waste time, you could spend money on content which isn't valuable. So you want to be working on IP that's aligned to your strategy and that's aligned to the market needs and the client needs that you're dealing with. And you want it to be beneficial to you in delivering your services, so either reducing the cost or the time, increasing the quality, etc. And a good way to make sure that that happens is actually by making the responsibility for it someone in the senior management team. So if you think of important areas of your business, finance, sales, delivery, if you were in a room with your senior management team, you could ask who's responsible for each of those things, and someone would probably stand up. But if you asked who's responsible for intellectual property, would someone respond? I suspect maybe not, or at least the responsibility wouldn't be quite as clear-cut. It wouldn't necessarily be a specific person. Now, IP is a key driver of value in your business, so it's critical to, it's critical for you to scale. So it needs that experienced sort of responsibility tied to it. It allows you to really quickly scale delivery capacity by reducing the time to onboard people, training new staff, and you can leverage those cheaper resources for higher quality, higher value work, so it can directly, positively impact your bottom line. So the decision really is where to focus your attention on your IP development, and that's really dependent on your firm. It's dependent on your proposition and the market you're working in. But the way to go about it is to first make sure you've got your strategy clearly articulated, and then to align that IP development to that strategy. IP is a real win-win, basically, because if it's aligned for you and beneficial to you in running your business, it's going to be aligned and beneficial to the buyer, because that same leverage applies. And the leverage will be even more pronounced from a buyer perspective because they've got that next level of scale. So they'll be assessing your IP to understand how they can use it, how easy it is to use, and because it's more useful to them, then it'll be more interesting for them to buy you, and we can argue a much higher price with your firm. The next question is, should I make an acquisition to drive my growth? So acquisitions can be a very seductive solution to the need to growth and to scale, and it can be the right option, but there are risks associated with it, as we always think. So if we take another sort of theoretical example here, if you imagine a 5 million firm, or you are a 5 million firm, say, and you know another firm that's about 3 million, you've known them for years, you work in a similar space, it seems like an easy, obvious solution to acquire them 8 million revenue. Great. And maybe it is an obvious option. It might be a good one, but there's a number of things that you need to consider to make sure it's a strategically sound option to deal with. So, for example, thinking about the respective offerings, are they truly compatible, or actually is there competing methodologies at work there, even though they're similar services? Will those offerings complement each other? Could they actually provide synergies that mean that 5 plus 3 equals 10? Or actually, are they too similar and there won't be any synergy? That can be okay too if the goal is capacity building, if it's sort of recruitment. But if you want to do that, you want that to be a conscious decision to build capacity rather than expecting big synergy and just getting sort of capacity and feeling disappointed. There's other questions around client synergies, cultural fit, especially in service-based people businesses. Cultural fit is very important. How well those firms operate together. Egos in the process. Will one CEO be able to work for the other? Could it cause problems going from what is a tight-knit decision-making team, work together for years, to suddenly maybe twice the number of members? Will certain people cope with that, with not being the top dog anymore? You hear in the news about failed deals. We hear about AOL, Time Warner's probably the most famous historic example, classic. But really, actually, most deals and integrations are pretty successful. You hear about the failures because they're newsworthy, especially when they happen in the Fortune 500. But they happen because the sorts of questions that I've just mentioned either haven't been considered or haven't been sufficiently analysed, or they've been overly optimistic. And if all of those things have been considered, maybe, and the answer is yes, maybe there is a good strategic reason to acquire. And that is the first fundamental step. But then the next consideration is actually, can you, as a firm, cope with an acquisition? Do you have the capability and capacity, the management skills and the management time to make it happen? It can be a big boost to capacity, which is great, but it's not, it would be unfair to describe it as a quick solution. It's true, obviously, on the day it happens, yes, the firm will grow overnight, but there's a big lead time in acquiring a firm. It's a significant undertaking. You've got to take maybe 6 to 9 months for the whole process with the DD, the due diligence, and during that time, it can be distracting to your team. So one of the things that we do when we're running a sell side, our deal lead, one of the key jobs that Bruce does is to be the key point of contact for the buyers to shield the client and their team from all those distractions and interruptions, because you don't want your team to be getting pulled into the process, taking their eyes off sales and delivery targets, because suddenly that 5 and that 3 firm combining might only be making 7 million or 6 million come the end of the year, because in all the excitement, things have slipped through the cracks and some targets have been missed. Then once the deal's happened, there's the integration piece, and that's a bit more again. But the important thing actually to consider with that is, where are you on your personal journey? Because if you're planning to sell in the next couple of years, integration could take 6 months, a year, but actually the new combined firm won't really be ready to sell for probably a couple of years. Most buyers will be a little bit wary, and that's not all the time, and there'll be exceptions, but if you're planning on selling in the next couple of years, it's probably better to avoid looking at acquisition right now and look at other areas. Now, I'm conscious that a lot of what I've said here around acquisition might sound quite negative, and that isn't the message I want to give, because it can be a very successful means of growth, and it works very well in a lot of cases, as long as it's carefully considered. We've helped clients with finding the right acquisition target for their to fit their strategy, working through the strategic questions, understanding the synergy, helping them structure the deal by considering all the things I've just talked about and more. But it's not something to approach naively. If you're looking to sell in the near future, it's something to think about, because it adds that layer of complexity. So the fourth and final option we'll think about here is, should I diversify my offering? You're having more services. In some ways, definitely makes life easier. You've got more to sell. If you're talking to a current client, perhaps you're sort of got a project that's running to its end. You're going to finish. You've got nothing left to sell them. That's probably not something you want to do. You don't want that client to disappear. So designing a new offering might be a good way to keep that relationship going, keep that revenue going. And once you've added it, you can also re-engage past clients. So far, so good. But on the flip side, as Bruce has said, as you increase the number of services you offer, you're diluting your focus. And you can get away with that to a certain point, as long as you've got a sort of coherent set of propositions. What you don't want is to go from being a respected specialist to being seen as a jack of all trades, a master of none. And that's true both from a client looking at your firm, wanting to buy your services, and a potential acquirer looking at your firm. They want you to be a specialist, an expert. They come to you because you know this better than anyone else. And in a buyer's case, they want to be able to easily understand what you do and to fit you into a department and how you fit into their firm. So when the corporate development team is writing the business case for acquiring your firm, you don't want that to have to go to 5 different departments and solicit buy-in from too many different people, because that's adding extra complications, extra stepping stones in the way of the buyer. And the more stepping stones and things the more roadblocks you're throwing up, the more complications, the more chance there is that deal might not happen. It's a big task doing a deal and being acquired, so you don't want to throw up potential issues that might cause problems when that time comes. And there's other considerations around adding services that you and buyers will equally want to think about. So do the people and skills needed to deliver them, are they the same? Can they be delivered for the same gross margin, all our different services? Can they be sold together? You don't have to answer yes to all of those, but the more divergent you go, the more difficult it is to run the firm, and the more questions it's going to raise, the more eyebrows it's going to raise to a buyer. You don't want them to be questioning why you've got one service and another service and thinking they don't fit together. You want them to be looking at your firm thinking, yes, this firm offers a real set of key services into a clear niche, and I can understand how that fits into my, as the buyer's portfolio, alongside my services. Right. So if there's just a few things to remember from this webinar that we want you to take away, these will be it. So you can ensure that your business growth translates into equity value growth by making the right decisions and avoiding the mistakes and missteps along the way, and that's our smart scaling, as we call it. Buyers like 4 key things. They want to have confidence in your performance. They want size. They like focus, and they like leverageable IP. And you can do that and give them that confidence and give them the things they want by considering how a buyer will view your firm when you're making your decisions right now that are going to affect your future. You know, you can ensure you're building value alongside building your growth. Great. And now I think Alan will be posing some questions to us around, depending on what you've sent in.
Gentlemen, thank you very much indeed, Bruce and Adam, for your presentation. If I might say so, commendably clear as well as on time. And that clarity, I suggest, is reflected in the fact that we have yet to receive any questions from our participants on the webinar. But I wanted to take this opportunity perhaps to just, while people are thinking of their questions and perhaps typing them into the box on the right-hand side of their screens, just to ask a couple of mine, if I may. I mean, you quite rightly put the emphasis on growing the business and how attractive that is to potential buyers, as well as intrinsically attractive in its own right, I guess. But for many firms who talk to us, there is some trade-offs on occasions, certainly in the short term and maybe in the long term, between growing revenues and maintaining margin and therefore profitability. From your experience, you know, how should owners of firms, managers of firms handle that question, the choice sometimes between those two?
Well, it depends what it is you need to do and what you're thinking of spending money on. As you said, a growing top line is invariably a good thing because it means that you have something people want to buy, and any future valuation that net backs future profit is going to have a bigger number because it's just getting bigger into the future. But clearly you don't want to just push that top line if it's going to cost you too much of the bottom line. But there's a lot that can be done in terms of, if you are making genuine investments in the business in order to achieve that, then you can adjust that cost out and show that the growth is with a good gross margin, and you've just made some interim investments, whether it's in IP or a new market or whatever it is, one-off costs, and therefore just defending, not investing in order to protect the bottom line, provided it is clearly an investment, then that would not necessarily be a good idea. If it's just vanity expenditure and things that can't be justified as an expenditure, like a new accounting department, then that would not be a good thing to invest in. So keep that top line going, but make sure what's retaining the bottom line is adjustable out when presenting the underlying profitability of the business.
Many thanks. We've got a very topical question which has risen since June the 23rd. Has Brexit, and indeed how has Brexit affected the appetite of buyers to acquire consulting firms? And let me just say to you, it's too early to say is not an acceptable answer.
Well, clearly, Brexit was not going to have instantaneously a positive impact, because it wasn't going to make someone go and do something on June the 24th, but it might make them not do anything. And we've actually got two transactions going ahead at this very moment in time for UK businesses being acquired by European businesses. And straight after the deal, one was cancelled. They said, if Britain's out of Brexit, we don't want to acquire in that country. The other one is going boldly ahead, and we'll hopefully announce it soon. Their argument being that, you know, Britain's a great place to do business. You know, we're carrying on. This is where we want to be as part of our global expansion, and so the acquisition is still taking place. So it hasn't stopped. Clearly, some things are going to be postponed, but it hasn't stopped it all. And certainly, as we reach out to buyers, we're now getting back going. Obviously, it happened just beginning of the summer, and you don't take businesses to market in July and August because people are not that accessible. But as we reached out to potential buyers of businesses, we're starting to do that beginning of this year. We are not seeing that as a no to acquisition. The people who've been buying businesses still have to buy businesses. They have to grow, and Britain is still a big market in consulting. It's equal in size to the German market, and it's one that people can't ignore. So a short-term impact, medium-term, what happens post 50, and then the actual exit. I'm afraid I lack the vision to be able to answer that question. But at the moment, there is no reason not to progress because of Brexit if you're looking to exit.
And does volatility on the exchange rate affect people's attitudes very much?
People are not in the sweet spot, the 5 to 25 million. People are not buying for a financial reason. There's a financial number that gets used in working out the value, but they're buying for capabilities and things like that. So you might argue a British business is 10% cheaper now. I mean, I'm talking a little slightly Britain-centric right now, but obviously we work with people all over the world. So exchange rates have positive and negative. So we haven't seen that as a reason for people not wanting to do anything. We haven't actually had people saying I'm spreading my exchange rate risk, because that doesn't tend to be the reason that these sort of transactions take place.
Brilliant, many thanks. Perhaps I could just mention to colleagues on the webinar that there will be an email address coming up in a couple of minutes. So if you have questions which, as it were, are quite particular to your own firm, to your own circumstances, I'd suggest using the email address that you'll see in a minute. One final one from me, if I may, to either Adam or Bruce. You talked about the importance of focus in a number of dimensions, and the focus on sectors. Now, a lot of consulting firms do already, and this becomes more the case, I guess, as they seek to grow, work across a number of sectors. And in your experience, does that fact either mean that they're scaling in a difficult way, more difficult for themselves, and in a way which, in the end, makes them less attractive to potential purchasers?
There is no doubt there are some services that really are sector agnostic. Say you're involved in some kind of IT infrastructure, then whether you're migrating the database and servers of an oil company or a retail company or a government department really probably doesn't make much difference, and therefore I would say that's far less important. But if you are in supply chain advisory, then quite clearly, if your expertise in oil and gas, if you walked into a retail business, you would just not be talking the right language to the buyers. So the more technical your and technically and sector agnostic your service is, the less the need for sector focus would be the balance there. But if you can do it in one sector, it is always better if you can.
Many thanks. Thank you very much indeed. What I suggest we do now is with a reminder that people can ask questions, as it were, directly to you and get in touch with you. Adam and Bruce, your concluding thoughts.
Sure. Well, excuse me. So, yes, if you've posed a question that we haven't had time to answer, or if you've got any that you still have or you think up afterwards, please give us a call or an email. If you'd like to discuss anything that we've talked about on this webinar or any aspect of your plans to sell, please contact us. My email, I think, should be on in a moment. If not, it's adam.blatchford@equiteq.com. We can send it over the webinar chat in a moment. And also, if you aren't already a member, then please do join our Equiteq Edge Club. So it's a free source of information for consulting firm owners that are looking to see value in their businesses. So there's expert guidance, there's unique research, there's guest articles, and there's lots more. There's including a monthly newsletter. So if you have any questions or comments, please contact us, and we'd love to hear from you.
Many thanks to both Adam and Bruce there for excellent presentation. Thank you to everyone who has attended. Thank you in particular to Tim for his question, and to all of those of you who will be in touch. There will be a recording of this webinar, which we will send out to you in the next 24 hours, so you'll get the chance to experience it all over again and to share it with your colleagues. Thank you and goodbye.